Welcome back, traders and investors. We have Cate Long on the line here. She is a Reuters financial blogger. Cate, how you doing today?
I'm great, Joel. How are you?
Good, good. Just give us a little bit of your background, your education, and your background in the markets, and how you ended up to be a blogger for Reuters.
That's a good question. I've been working in financial markets, particularly the bond markets, for about 14 years. I worked first in a financial PR firm, and then I went to work for an investment bank, ING Barings, which is a British bank. And then I started getting more involved with the industry standard setting for electronic trading. Did that work for quite a while. That's migrating fix, which is the standard equity traders use, into the fixed income space. And then I started working more broadly on regulation of credit ratings with the SEC and Congress, and then was very involved with Dodd-Frank on the Hill. Working, I had an open source project for the staff of the Senate staffers as they wrote the law that covered financial regulations both at the national level and the global level. And then Reuters said, "You want to write about the bond market?" I said, "Sure, give it a try."
Okay, you're talking about a lot of the fundamentals there, but when you're looking at like muni bonds and junk bonds and anything within that arena, there has to be some math involved, right? There has to be analyzing the yield curves and where interest rates are
hmm
going and stuff. How did you get your? I don't think you mentioned anything there as far as your mathematical breakdown or or the real analysis that goes into analyzing the bonds.
Yeah, that's absolutely true. And if I were a bond trader or a portfolio manager, or I guess even a investment advisor that recommended specific bonds, I would need that. What knowledge I have on the quant side was self-taught, but I'm more of like a market structure person. I don't recommend individual bonds to anybody.
Okay.
Um, I,
Interesting. You talk
I mean, I
about.
know how to do it, and generally I mean, most of the good systems that are out there for muni traders and reps, have very good yield analysis tools in them that you use. I mean, most people don't sit around and do the math themselves anymore.
Right, it's
Um,
all done by computers. So, okay,
right.
we got a couple different areas to talk about here, and I'm gonna save the best for last here, talking about the Motor City. But
Eh.
let's talk about a little bit what's going on in the Puerto Rican municipal bond market.
So Puerto Rico has about $70 billion of debt outstanding, of which about 20 billion around is general obligation debt, which is directly insured by the Constitution. The other 50 billion is corporation debt, which is things like the water system and the electric system. The Puerto Rico has been in recession for about 7 years, and people continue leaving the island, and so the tax base is shrinking. So they've been trying to service this growing pile of debt with a shrinking base of taxpayers. And the Puerto Rico did this giant general obligation debt offering in March. It was 3.5 billion. It was rated double B. It's the largest high yield municipal offering ever in the market. The bonds came at 93. They've since traded down to 89. They've sort of
Oof.
flatlined around to 89. The yield on those bonds is over 7% when they came, and so they're moving more towards 8% now. Very, very rich yields, extremely rich. All the Puerto Rico bonds have extremely rich yields and are higher than really basically any bonds globally other than Ukraine and in Venezuela. So it's a very interesting situation that's on fire basically, and a lot of people are very hesitant to go in and take the bonds down just because there's so much risk politically and economically there.
Well, with declining revenues and rising debt, not a good situation. Is there a lot of U.S. government or U.S. investor exposure in Puerto Rico?
The numbers typically that we can look at is mutual fund holdings, and there hasn't been um, there has been basically a dollar sort of flatlined on a dollar basis, but the bonds have moved up in price over the last 6 months. So it's a little hard to say generally, where holdings have gone. It's just been kind of on a par basis, it's gone down, but on a price basis, it's gone up. So um, People just hesitant, you know, and there's a lot of headline risk for mutual funds to hold those bonds because retail investors, you know, they hear all the bad news and then they look on their statement, you know, their mutual fund statement, they see all the Puerto Rico and they call the mutual fund. They say this is scary or they sell the mutual fund.
Right, right.
So it's difficult. There's a lot of yield there. I know a lot of big portfolio managers would love to own the debt, but it's still pretty unstable situation there.
Too much risk and too little reward. So, I mean, you were looking for, different events and circumstances to derail this great bull market. And you talked about some sizable numbers over here, but Puerto Rico is not likely to be the catalyst that takes this whole market down. In your opinion?
Definitely not. You mean the equity side of the market?
Yeah, like the U.S.
No,
market. I mean, you're always looking for like,
no,
something. No, I mean, things start out, Puerto
no,
Rico, and then then there's another country, and then there's another
no.
country. Is there any other country or possessions that you see, going the same way as Puerto Rico?
So the Treasury Department has been monitoring Puerto Rico extremely closely. I've been writing about them, you know, having, you know, solvency problems for 2 years, and there's other people, you know, so it's not a news story for the municipal side of the market. And it's big, but it's, you know, I think it's, you know, if it really rocked out where it was going to explode, Fed could step in, buy the Puerto Rico bonds on a short-term basis, prop the market. You know, I think there's plenty of ways for, you know, the government or the Fed to forestall any kind of fire sale.
Yeah, they
But
have they have plenty of experience at that.
exactly, they got a balance sheet that could absorb
You did
a lot of Puerto Rico debt pretty
exactly.
easily. Yeah, so I just think that, you know, it's more of a political situation. I mean, the solution has to be a political solution in Puerto Rico where they decide that they're going to downsize the government, you know, sort of stabilize the fiscal situation. Many of us think that what they'll do is selectively default on the electric bonds, which is called PREPA down there, which is the electricity monopoly. There's about $8 billion of that debt out. Most of us feel like those bonds trading around 65 cents.
Wow.
So, you know, most of us feel like that's probably, you know, where the government, if it goes anywhere on reorg, will go on the electric side and the highway. There's also this highway bonds, a couple billion of them.
Okay,
So
another emergent story is the Kentucky public pension system, and I guess it's in devastating shape. That doesn't sound very good.
yeah, so this is a terrible situation. You hear about public pensions in Illinois. Everyone keeps talking Illinois, Illinois, Illinois. And Illinois is in very bad shape, has about 50% of the assets it needs to cover its future liabilities. But the untold story is Kentucky. The general retirement system of Kentucky has about 23% of the assets that it needs to cover future liabilities, which is terrible. I mean, which is getting into the range of Puerto Rico, which has like 7% of the assets it needs to cover future promises to retirees. But in the case of Kentucky, was this landmark bankruptcy lawsuit that was decided against the retirement system. And it's really bizarre in Kentucky, but they have about 50 plus nonprofits that are not government units, but that are nonprofit organizations that provide social services that were allowed to go into the Kentucky retirement system. But the retirement system has been loading these massive pension costs onto these nonprofits, and one went bankrupt and went into Chapter 11. And the bankruptcy judge says, forget it. You can leave the Kentucky system. You can stiff your liabilities there, basically. So this really massively unfunded pension system now may have a massive exodus of all these nonprofits that are struggling to, you know, be able to carry the pension costs. So we'll see. I mean, it could be. I mean, that could be devastating. It certainly would not, you know, disrupt the municipal market. Kentucky's not a big player. They don't have much general obligation debt out, but just more on a legal basis, it's really, really, really a messed up situation.
So they were letting nonprofits into their public pension system?
Yep.
Is there any other states that are doing that?
No, I think it's the only one.
Really? Well, that would be.
Yeah.
Wow. A few years ago, Meredith Whitney, I believe, just called for, a collapse of the entire municipal bond market, and that's kind of as we were coming out of the financial crisis. Where do you think she got things wrong?
So Meredith, actually, a lot of her analysis, I think, was based on these pension systems, and she somehow equated it, I think, in her mind to debt, that these were like liabilities that had to be rolled over and refunded. And I mean, I just think she had like the whole vision of cash flows and time basis and everything kind of messed up. There are serious problems in the municipal market for pensions. Some states have heavier debt loads than they have, but they can be worked out over time. And what I think Meredith really missed is that states very easily can contract their cost base. It's very easy for them to cut um, their expenses, and they also can raise taxes very easily. So there's a lot of flexibility on the more on the state level, but also on the local level for them to manage their balance sheet and to manage their cash flow.
Okay, so now it's subject interest near and dear to us here at Benzinga, Detroit. You know, going through its major bankruptcy. Ken Orr has come up with some different strategies. Just give us your short-term outlook. I mean, a lot of people they're losing a good percentage of their investments in Detroit. How just give us your
hmm
take on this and what could be happening moving forward.
So basically, the previous governor, should have put Detroit in bankruptcy years ago. It was a really bad move to let it fester as long as it did. Now it's in bankruptcy. The secured bondholders' general obligations are taking about 74 cents. They're haircutting them down to about 74 cents. Although in that case, the bond insurers are making up the difference. But they're also just come to a settlement on another class of general obligation bonds, which my guess is they'll get about 60 cents on the dollar. Overall, the other big place that they're reducing cash flow requirements is in the pension funds. They did this grand bargain, so the city is not going to make pension payments for about 10 years. Big relief for the budget. And they also massively haircut the retiree health care, which was a big, about $50 million a year out of $1 billion budget. So if, once all the court, theatrics get done, the cash flow for the city of Detroit will be in much better shape. They're not raising taxes, which is, kind of a disappointment to all of us, because they don't collect a lot of taxes there.
They don't
But I
collect
think,
any taxes. No, I mean there's a, they don't collect taxes. They don't have people pay their parking tickets.
right,
they don't have people pay their real estate taxes. I mean
right.
there's a lot of fun but so with everything that's going on moving forward. I mean what what's your outlook? Is Detroit going to be able? I mean new income sources. I mean, you do have some tech companies moving down there.
hmm
Expanding the tax base. One deterrent to people living in the city is a very high, city tax rate. I mean,
hmm
is this going to be too little, too late, or is this going to be enough to turn to get the city back on solid footing?
So this is the critical question, the one you raised, and in my mind, it's pivots on the school system. You cannot attract people into a community if the school system sucks, because you're paying taxes and you can't send your children to school. And Detroit is still on its knees in terms of the school system. So I think there's many positives, about this whole reorg, this bankruptcy and stuff. But in the end, it is a question of community viability. And when your schools are a wreck and they're still controlled by the state in Detroit, I think it's going to be harder for them to really make the progress that they would like to make there.
I mean, is there anything going on with perhaps any possible offerings to? I mean, because what's it going to take to fix the school system? It's going to take money, and you have to get qualified teachers in there. And well, first of all, you need the students, and you need the kids. Is there are they taking any
hmm
are they taking any steps with with the new budget to address that problem?
So in most places, this is what's very interesting about the muni market. The school system is a separate legal entity from the city. and they raise money through property taxes, and they have their own legal control. So it's hard for the city to really, do much in terms of changes for the schools. In the case of Detroit, the state is overseeing the cities, and they loosened up they loosened the ability for students to leave the school system, and either go to another community's schools or to go to a charter school. So the question is, what happens? That's a big question in many cities in the country. What happens when you give, students the ability to migrate, exit a school system, but you still have a fixed cost structure, and you still have bonds, right? You still have a lot of debt and pensions and, fixed teacher costs, buildings. What happens? Think 5, 10, 20 years. What happens to those cities? And basically, it's like any situation where you have high fixed cost and a declining revenue stream, it gets squeezed. And does anybody in Michigan want to put more money in those schools? I don't think so.
No, no,
So,
not someone like me, but it's whose kids are done with the school system. So overall, okay, you've had just this incredibly low interest rate environment for years and years and years. Fed just willing to print money and keep the economy afloat. For people that have, municipal bond holdings, I mean, you talk about, Kentucky, who's having problems but has little exposure. You look at a
right.
state like Illinois, who sure looks like it could be, going, the first state to get, declare bankruptcy as opposed to the first city. I mean, is there any reason for, people that have large holdings in muni bonds? I know it's specific to the particular area, the municipality, but
hmm
sure doesn't look like our last guest kind of thought we're going to have hyperinflation and interest rates going through the roof. I don't know if I could really agree with that opinion. What should investors in municipal bonds look for besides the things going on in individual cities for on the more macro fundamental outlook to really, take a close eye and maybe perhaps put their money somewhere else?
It's, for the municipal space, it's the same as any fixed income. It's a, chase for yield, right? It's like the Hunger Games for yield. Everybody's looking for some additional yield somewhere. We're just kind of bouncing along with the treasury space. We don't have any dynamics that are particular to the municipal market. I think inflation is very hard in this, economy when there's so much slack on so many levels. If there's Middle East troubles and oil prices spike, I think we'll see, runoff into the general economy. Not like we did in the 70s, but we will see runoff because we're still very oil dependent. But generally everything's just kind of trugging along. What we look at in the municipal space is tax collections. That's our, we look at that like other parts of the market look at labor statistics, but we look at on the state level how tax collections are coming in on a quarterly basis. And that sort of trickles down to the locals because a lot of states drive money down to local governments for school, higher ed, Medicaid. So that's really where our focus is, more on just on a pure cash flow
The
basis.
money coming in to pay the money that's supposed to be going out, right, Kate?
That's it.
Oh,
That's our game, man.
okay. Cate Long, Reuters financial blogger, giving her outlook on Puerto Rico, the emerging Kentucky public pension system, and on the Motor Cities. So, Kate, thanks a lot for coming on our show. You
Yeah.
definitely have
Thank
given us. I feel like I know more about the muni bond market already. So, thanks for coming on, and we hope
yeah,
hope to speak to you again soon.
that'd be great. Thanks so much.
Bye bye.
Bye.